Here's a retirement tax strategy that most people, even accountants, overlook. And what I'm talking about are qualified charitable distributions. Hi, my name is Michelle, and I'm a financial advisor here at Financial Design Studio, where we help business leaders choose when they retire. And one of the things we focus on is tax efficiency. Now, after they retire, many professionals find themselves paying taxes at the same or higher rates as when they were working. And in retirement, high income means high taxes and high Medicare premiums. But there are strategies to combat this. One of the favorites is qualified charitable distributions because you can save in taxes while also giving generously. So first, what is a qualified charitable distribution? And in short, that can be called a QCD. So this strategy only applies to people who are giving charitably and have money in an IRA that they want to give away. So this is really who we're talking about, who this applies to. So first, we start to look at the expenses that a client is spending. So let's start here and assume that someone is spending around $100,000 per year just in all of their total expenses. And of this amount, let's say that their living expenses like utilities, gas, things like this, makes up $60,000 of this amount. And then let's assume that they're also giving, and that makes up $20,000 of this amount. And then let's say that travel, because they're kind of in the middle of retirement, they're still enjoying some travel, but they also like to give, let's say that's the other $20,000. So this is where and how we start to highlight which strategies might apply to you as a client. So for example, we've noticed this is something that they like to do, is to give. And so now we start to think of, where does this money need to come from? So remember, you're retired, you no longer have a paycheck from your employer. And so this $100,000 of expenses needs to come from somewhere. And that can come from a combination of income and investments that you've saved for the future. So when we think about even those investments, we think about different types of accounts. So an IRA, a 401k, maybe even a brokerage account. So you've got a few different places you can take it from. This is where you have to be really careful and you have to know all the details. This strategy could work for you if you have an IRA. And this is where we're really looking for, okay, we want to take this money specifically from the IRA. And so that's how you know if this could work for you. Now, the benefit of doing a qualified charitable distribution is that this amount that we're taking out of the IRA can decrease your taxable income, which can decrease Medicare premiums that you're paying. It can also affect your estate planning. It can benefit you in the sense that you're able to do some of that giving today that you want to do in the future. So it's helping you to do it while you're still alive as well. So now let's talk about how a QCD works and some things you need to know about it. Is there a maximum of how much I can do in a distribution? And there is. The maximum is $108,000 per year, per person. And so this is important because let's say a married couple who likes to give charitably wants to give a lot of money away. The husband can give $108,000 from his IRA, and the wife can also give $108,000 from her IRA in 2025. Now, this amount is adjusted for inflation each year. And so now let's just talk about what are the steps of a QCD. So really what you're doing in order to do a QCD is you are taking money from your IRA and you are sending a check directly to, so you're distributing money directly to a charitable organization. And this is any organization that is a 501c3 organization. It's acknowledged by the IRS that it is a charitable organization. And that is important because there can be charitable purposes that people want to give to, but it does need to be a 501c3 organization. So finally, what are common QCD mistakes for retirees to watch out for? Well, first, one of the big ones is that you only take these funds or a QCD from your IRA. It's very common for people to think, I'm 70 and a half now, and so now I can give money to charitable organizations right from my retirement account. But you cannot do this from a 401k, so it needs to be an IRA only. Another is that people are doing both a QCD and an RMD. So let's say that someone has an RMD this year of $50,000. Now, you could take the full $50,000 out as just a distribution, you deposit it in your checking account, and now that $50,000 is taxable to you as income. However, someone that knows they're going to be giving $20,000 of funds to charitable organizations could say, I'm going to take $20,000 as a QCD, and then I'm going to take the other $30,000 as a distribution to myself. So they're sending those funds to the charitable organization, and they're also taking the rest to pay for their other living expenses that they have. The difference in that example is that the taxable income you'll have will be $30,000 if you do the QCD. Another common mistake could be someone who wants to give all of their money to charitable organizations, but they're doing Roth conversions today. So someone who's giving it all away will never pay taxes on those funds anyway, nor will the charities they want to give the money to. So why would you do Roth conversions today to pay taxes on that when you don't need to? Another mistake can just be not doing them today at all. So someone who likes to give charitably and has a retirement account and is over 70 and a half, a QCD can absolutely make sense. So be sure that you're doing them if it's possible. And then the next mistake can be not doing a QCD and not deducting those funds either. So someone who is not doing a QCD because they aren't aware of it is just giving money from their checking account or from wherever they want to, and they aren't giving enough to even make it deductible on their tax return. So, for example, in order to have deductible charitable contributions, you need to be itemizing on your tax return. And that means an individual that has charitable giving or other itemized deductions of over $15,750 and a married couple of over $31,000. And so this is where you can see you need to have significant itemized deductions if you're not doing a QCD. So you can see how this person, the mistake is they're missing out on actually both the potential to do the QCD and decrease their income, and also they're not even able to deduct that charitable contribution because their itemized deductions aren't high enough. So they're missing out completely on the charitable giving that they're doing. And then finally, the last mistake can just be that people that are doing it too early. So 70 and a half is an age where most people are already maybe 2 to 3 years in retirement. You can think, oh, well, I'm retired, I can do these QCDs. However, you do have to wait until you're 70 and a half to start them, and then you can do them anytime after. So if you're starting to plan out your retirement, that's who we help best. Our team specializes in comprehensive financial planning and investment management, so you stay on track all year, every year. Reach out to our team at financialdesignstudio.com to schedule a 30-minute consultation about your retirement plan. We'll see you there or in the next video. Thanks for watching.